So, what is ESG? So, ESG, or Environment, Social and Governance, is a framework that helps stakeholders understand how firms manage risks and opportunities related to the environment, social and governance criteria. So, for the environmental criteria, it's actually focused on organizations' impact on the environment, which includes direct and indirect greenhouse gas emissions and natural resource management. As for social, it actually focuses on organizations' relationship with stakeholders such as employees, customers, shareholders, etc. As for governance, it actually focuses on how organizations is led and managed, how the leadership incentives are aligned with the stakeholder expectation, and the internal control that exists to promote transparency and accountability on the part of the leadership. So, why is ESG important? To the investors, ESG is important for risk management because incorporating ESG factors into investment decisions helps investors identify potential risks that may not be apparent through traditional financial analysis. To the regulators, meanwhile, without strict oversights from the regulators, companies can face massive incentives through greenwash, which is exaggerate their sustainability credentials to attract capital. So regulators, they will enforce these standardized disclosures so that investors can have accurate, comparable and reliable data to make informed choices. To the public, meanwhile, ESG is actually a tool for accountability so that they can ensure that the company making profit doesn't do it on the expense of human dignity, public health or the planet.
Now, I'm going to explain how ESG considerations impact audit scope, procedures, and professional judgment. Okay, first of all, audit scope. Assurance engagements about non-financial information may be obtained by auditors, and this is most likely to involve reviewing management on sustainability, social, and environmental information. This kind of information is also known as extended external reporting (EER), and in certain jurisdictions, listed and bigger private corporations are required to submit it. Furthermore, a lot of business prefer to give more details on how their corporations affect the environment. Okay, now let's talk about audit procedures. So, ESG considerations affect audit procedure by requiring auditors to perform additional testing and evidence gathering activities related to sustainability information. Auditors may review ESG policies, test internal controls over ESG data collection, and verify environmental and social performance metrics as compliance with ESG regulations and evaluate the reliability of sustainability disclosures. So, higher risk ESG areas such as greenhouse gas emissions, supply chain practices, and climate-related estimates often require more extensive substantive testing and verification procedures. And the auditor's risk assessment also influence the nature, timing, and extent of this procedure. Okay, last but not least, let's talk about professional judgment. So, ESG matters require the auditors to give greater professional judgment, whereas the priority of work focuses primarily on financial audits and any impediment to professional skepticism that is specific to the ESF audit context will be examined. So, literature by availability and intervention proposed by IASB is added to make sure that the auditors is aware of the factors that may impact their professional skepticism.
I'm going to talk about major challenges in providing ESG assurance, which is greenwashing risks. So greenwashing occurs when companies exaggerate, mispresent, or make unsupported claims about their environmental, social, and governance performance. This creates when a risk that stakeholders are misled about the company's actual sustainability practices. Why greenwashing is challenging for auditors is because it about data fragmentation and unreliability. ESG data is often collected from different departments, subsidiary and supply chains. Lack of standardized system and internal control are led to inaccurate and incomplete information. Next is regulatory and standard mismatch. ESG reporting standards are vary across country and industry. Companies have flexibility in choosing what information to disclose. This may enable selective reporting of positive ESG performances and while omitting negative aspects. And lastly, liability and reputation risk. Auditor must assess subjective and forward-looking sustainability claim. Failure to detect greenwashing may result in legal liability, reputational damage, and loss of public trust. And professional judgment is required when evaluating the credibility of ESG disclosure.
Hello everyone, my name is Darwisyah, and today I would like to explain how to address the ESG challenges based on my friend's Ika explanations. So, one of them is we can establish the automated data pipelines and ERP integrations. This is because when the accountant do the manual accounting processes like the bookkeeping or recording or journaling, those processes are able to access and gather information manually, right? We have many sources in manually. So, and as for that, it can lead to the error and material misstatements. So, as the auditor, we can eliminate and reduce the risk or the error by using the system, which is the ERP integrations. On the other hand, the auditor also should utilize the blockchain for supply chains and also source verifications. This is because many companies usually pick positive data, which is they ignore the negative data or not stable data, and this term is also has the name which is cherry picking. So when they are doing the cherry picking, they also automatically make a greenwash statement, which means in their financial report they do not show the exactly situations of the data because they only pick the positive data. That means they are not provide the relevant and reliable data to the external parties like shareholders or investors. As for that, the auditor should take initiative to verify the origin of the sample of data without relying 100% on the report that had been given from the company. So because we need to help the investor and shareholder to make the reliable, relevant, and trustworthy decisions. Okay, I think that's all from me. Thank you.